thank you, Nancy and Con. It's a pleasure to be here. I think the concept of the series is a wonderful one, and one that I hope will be, that I expect to attend or look at the videos with great frequency. My topic, as Con mentioned, is what happened the past 2 weeks in the financial bailout, financial crisis world. One could spend about 10 or 15 hours talking about that, but I'm going to try to boil down and go through the most significant issues. And I think the primary theme has been taxpayer reflected by congressional anger as to what has happened to our taxpayer money with respect to the bailout. Is the so-called capital purchase program, the providing of financial assistance to the largest bank holding companies in the world, in the United States, particularly in the United States, a good idea? And is that the way that we should continue to spend our money? Of course, in the interim, we have a new presidential administration. The Obama administration began, and it has its own take on how these issues should be addressed. But to sort of set the table and go back where we were, just briefly, you have to remember that when the first legislation was passed, the so-called EESA, the Emergency Economic Stabilization Act, initially the thought, the Bush administration, Treasury Secretary Paulson at that time, thought and suggested initially that those funds were going to be spent to, quote, buy toxic assets. And the big debate initially was, how could you price those assets? You know, they were at the moment worth far below what their par was. There was some sense that, you know, if you wait, quote, long enough, the market value is going to increase. And you don't want to spend taxpayer money and pay prices that are far in excess of market. So how does that balance, and how do you save the banks? The next thing that happened was, over a weekend, we all learned that the UK, which had a similar problem with a far fewer number of large banks, took very aggressive action, and instead of buying toxic assets in their regions, what they did was they made preferred various types of investments and required supervision by the UK government over many of their largest financial institutions. The following week, the Bush administration position changed, and we got the expenditures of the first part of the TARP, the so-called Troubled Asset Relief Program dollars, by, quote, making investments, in our case, in the U.S. case, all in preferred stock with warrants in the largest banking financial institutions in the United States. Now, did that make no sense at the time? I think the answer is it did make some sense at the time, in my view, because what they were trying to do was react to an immediate crisis and stabilize specific financial institutions that some, I think we would all agree, some of them at least, were too big to fail or would create a ripple effect and a true crisis within the international crisis. So what was the purpose of doing that? First, they wanted to make sure that the world heard, that they could be confidence that an international institution, for instance, could engage with confidence in a swap transaction or a financial transaction with another bank, with one of these largest banks in the United States, stabilize them, provide the public and particularly the financial community with some sense that these entities, not all the largest financial institutions in the United States were going to fail. They ended up providing standardized documents to make these preferred stock investments. And those standardized documents, to be clear, have no lending requirements in them today, as made. They have no requirements with respect to the use of those funds. And it was expected, in fact, initially, those banks were encouraged to consider using those funds to acquire less healthy financial institutions so that they could, quote, avoid a failure in the system by having a somewhat weaker institution acquired by a yet strengthened larger financial institution. But there's a clause within those agreements which gives the Treasury the unilateral right to make changes to those agreements in the event that Congress takes action. And people did not focus on that until much later in the process. And what's happened in the last couple of weeks is the anger in Congress with respect to the fact that placing those funds in these large institutions has not resulted in increased lending or availability of credit, has led to an outcry to let's not let the second part of this financial bailout, $700 billion package. $350 billion has already been spent, $250 on the investments in financial institutions. Let's not make this second part be so easy to use, and we won't tie it to some kinds of requirements that make sure that a number of things that are regarded as socially undesirable are prevented, and that the investment by the U.S. taxpayers ends up supporting lending activities. So the first major event that I want to mention is the introduction by Barney Frank, chairman of the House Financial Services Committee, of House of Representatives Bill 384. Now, it's generally recognized these days that that bill, which was introduced on the 9th of January, is unlikely to pass. It already has been voted by the House, but it is unlikely to be taken by the Senate, and it is unlikely to be supported as it is by the Obama administration. But what Congressman Frank was trying to do, and I think that there's some effectiveness to it, is there are many provisions in bills, and I'm going to go through some of the key ones that flesh out ideas that I think in the long run are going to be found in the final legislation that is adopted. Not all of them, but some of them. What he tries to do, and that the Act 384 is called the TARP Reform and Accountability Act, which amends the Emergency Economic Stabilization Act. In general, as it says, to create more transparency and accountability in how these funds are used. With respect to the usage of funds, one theme there is use 40 billion to 100 billion of the funds to avoid mortgage foreclosures. And it would require the Treasury, if it does, to suspend giving capital purchase program grants to banks in the event there's no foreclosure mitigation program in place by March 15, 2009. It also suggests that Community Reinvestment Act credit to be given to banks for loan modifications and other assistance to low and moderate income borrowers. That's related to the avoidance of mortgage foreclosure issues. Highly politically popular issue, it restricts the incentive compensation bonuses for the 25 highest paid executives at a bank that receives funds from the government. And there are certification requirements so that a company would have to certify that the information they're giving with respect to the non-payment of the bonuses is accurate and is being followed. It provides that no compensation incentives can be made for any of these to reward the taking of unnecessary or excessive risks by the executives. Again, and the next one is one that's always popular. It requires that any company receiving federal funds relinquish their private jets. That one, I suspect, will definitely make it into whatever final legislation there is. There's a lot of regulatory reporting and tracking requirements to see just how the funds being injected by the government are being used. Are they being used to increase lending above a financial institution's historic baseline of lending? It restricts the use of these federal funds to pay corporate dividends. In other words, they want to use it for lending. They don't want the corporation to pay dividends out of those funds. They don't want them to repurchase their stock with using federal funds to do it. Somewhat in contrast to what was, or different from the spirit in the initial purchase program requirements, if H.R. 384 were adopted, they would require the federal regulatory agency to approve the acquisition which used federal funds. And there's a provision that would not absolutely prevent, but discourage the use of these funds to acquire a healthy financial institution. Of interest, particularly for those of you who know me in the teaching context, I've always been particularly fascinated on board issues, board directors issues, and corporate governance issues. And there's a provision in this bill that would require that, or permit the Treasury to appoint an observer on board of directors meetings and board committee meetings. So there'd be someone for the Treasury sitting over your shoulder as you had your discussion with the board. It might just have a chilling effect on some of those discussions. In general, they want increased transparency on how the financial institutions are using the funds. Other provisions that are important are the act would permanently increase the level of FDIC insurance to the now temporary level of $250,000. That's another provision that I think will be fairly popular and is likely to find its way into final legislation. It encourages aid to states and municipalities to support their general obligation bonds, and that certainly is something that I think will also find support. It confirms the Treasury's authority to offer financial assistance to automobile manufacturers. Of course, some of that's already out of the door, but this bill would make it clarify the authorization to do it. It would help loan servicers avoid legal liability if they agree to modify home mortgage or a pool of loans based on certain standards. That's an important technical one. There is an issue on whether the servicer has the right to be involved in the write-off of mortgage loan terms and the values of those. And this legislation, if adopted, would provide legal authority and help those servicers avoid legal liability of that. It also would allow the FDIC to assess banks with a special, in addition to FDIC insurance coverage, a special assessment on banks and bank holding companies to cover their costs of open bank assistance. That's another area which is novel and that may find its way forward. So, as I said, it's unlikely that this entire legislation is going to be passed, but it is likely, I think, that a lot of those elements are going to be found in the final legislation and the use of it there. Now, the Obama administration came in, and they have not yet released the specific legislation or terms of how they want to address this financial bailout. They have, however, stated, and this is their alternative, in the past 2 weeks, their articulation of what their major objectives are. And those include stemming foreclosures, so you've seen some of that in Barney Frank bills. Revamping the government's bailout program, well, I think a lot of that's going to be along the same lines as as mentioned in the Barney Frank bill. Purchase toxic assets. I think there'll be a greater emphasis on that, obviously, than there was in the Bush administration, and it'll be highly increased, and it may go beyond, it's likely to go beyond what is shown in H.R. 384. I think the question, again, is always the tough one on that is, what price does the government pay and use taxpayer dollars to buy those assets? It can't be as high as the par value of the original loan. It can't be as low as the market value is in this depressed and illiquid market. And where do you strike the balance on those assets? What is the right purchase price to buy that? And there is no clear answer for that and a lot of discussion. Also, it's clear that there's going to be much stricter financial regulation in the Obama administration. And they have mentioned already stricter federal rules and regulation of hedge funds, probably by the SEC, stricter federal rules for credit rating agencies, and eliminations of the conflict of interest that exists because the credit rating agencies are paid by companies to help them structure the often exotic financial instruments that the agencies rate, and that I think Andy is going to talk about it in the next presentation. Stricter regulation of mortgage brokers, and here in Massachusetts we've done some of that on the state level. And greater federal oversight of the complex financial instruments, including credit default swaps. Those Obama administration themes are clearly what's been announced, and they are what's to come. But they have, as I said, the details have not yet been issued, and I think some of those provisions are going to find their way into, from the HR 384 into the final legislation. Now, what have the bank regulatory agencies been doing on these issues? Well, the FDIC clearly got out front. It was the first to issue requirements in financial institution letters to 2009 and 2009 require reporting essentially by banks on how they're using these funds. Their financial institution letter 1209, 2009, specifically requires, which was issued just about a week ago, requires banks to monitor specifically their use of capital injections, liquidity supports, or financing guarantees obtained through the recent financial stability programs. They not only need to monitor them, they have to, as almost all bank regulatory issuances have said for the last 10 years, if you don't document your monitoring, it's as good as not doing it at all. The banks are going to be examined, they're going to be tested on that, and they're going to have to show that they documented it and documented it fully. They're being encouraged as well to publish how they're using those federal funds. And just today there was some indication that for other than the top 20 banks, the FDIC is thinking that monitoring that public disclosure would come in additions or additional text and numbers in the quarterly financial statements call reports that are filed with the government. The other FDIC release on that required reporting with respect to how institutions that were using their guarantees of unsecured loans program were using those funds, how many were guaranteed, what the level of guarantee was, and certifications as to its proper usage. So after the FDIC took the lead, there were a couple of calls for why are they the only ones doing that? All of the agencies should be doing the same thing. And the next one out of the box was the Treasury. The Treasury issued a release in which first it announced that it had launched a letter and made it publicly available to the 20 largest U.S. financial institutions that receive capital purchase program monies, federal funds, and investments, to disclose how those funds were being used, how much was being used for business lending, how much was being used for consumer lending, and how much was being used to purchase mortgage-backed securities or asset-backed securities. Shortly thereafter, a few days thereafter, there was an announcement that the Inspector General of TARP of the Treasury was now sending out an information request to all other recipients of federal funds or federal investments through the capital purchase program to find out, again, how those funds were being used and were they being used for lending in particular. I think it's not long before all the other agencies join, and then there'll be a call for making the requirements uniform, and my guess is you're eventually going to have some form of uniform federal banking agency standard for what those reports and requirements are going to be. I think the next thing I want to talk about is the focus on liquidity. There has been a lot of, essentially, banks have been regulated for as long as I remember, primarily on their capital levels, that they were regarded as being well capitalized, having enough capital. It was generally considered that they weren't at risk of failure at that stage. This last crisis and some of the developments that happened even before the crisis at smaller banks have demonstrated that when liquidity dries up, when they don't have the ability to raise current funding needs, the bank can be in just as much trouble even if it is well capitalized. And there are reactions to that are coming up. There's a proposal to increase, for the FDIC to increase deposit insurance premiums for those banks that are overly dependent on so-called volatile liabilities. The most common form of volatile liability that's always spoken of is brokered deposits. But in fact, particularly as illustrated by recent enforcement orders, that is, orders taken about banks in the forms of cease and desist orders or memorandum of understanding, the FDIC and the other regulatory agencies have broadened their definition of the kind of liquidity and high payment liabilities they're worried about, or things that could be pulled quickly from a bank and eliminate its liquidity support. And some of those things, for instance, you might not have focused on, are Federal Home Loan Bank borrowings. Because once a bank starts getting into trouble, the Federal Home Loan Bank has a right to pull or reduce that line, their line of credit very easily, and therefore those deposits can go. Any deposits that are paid at above standard market rates are also defined within volatile liabilities in some of those orders. So it's a broader concern about that, and I don't think there's any doubt that somewhere in the next few months at one of these presentations you'll be hearing about a new liquidity regulation, probably by all of the federal banking regulatory agencies together as a joint agency proposal that standardizes some of those requirements. Already, as there's been some releases on risk management to require monitoring of those, quote, volatile liabilities and levels of them to control them, so that, again, a well-capitalized bank does not, for instance, lose its ability to act or to function and to act on a safe and sound basis very quickly because it loses its liquidity support. Yesterday, the FDIC put out an additional release, which was interesting because it was framed having to deal with brokered deposit. It was approved by the board of directors of the FDIC yesterday. It clarified what less than well-capitalized banks need to do, the rates of interest they can pay for broker deposits. And it standardized it by taking away the historical benchmark used in those regulations, which were U.S. Treasury rates, and replacing them by national averages generally of CD rates, of certificate of deposit rates, on a national basis, computed by the FDIC. Now, why would you think that? Now, that was regarded and reported by the agency as a clarification of the rates, because there was another provision that was if you were not raising your your rates on a national, your deposits on a national basis, but doing it on a local basis, they did not define the rates, the interest rates you were using. So you're getting close to
That's a signal.
So what they did in this case was they said, let's use national rates. If you want to use a local rate, a national CD rate, then we'll compute it and use that. If you want to use a local rate, there's a rebuttable presumption that you should use the national CD rate. If you want a local rate, because you're really only soliciting deposits from local areas, you can show us evidence that your rate is lower and better. And why? But the financial press reacted to that, and banks reacted to that as, that's great news. And why is that great news? It was great news because in today's crazy markets, unusual markets, the treasury rate spreads are so thin that yields are so thin that using this standard, which was described as tightening the standards by the FDIC, actually results in the ability to less than well capitalized banks to actually pay higher interest rates on those matters. Okay, with that.
Great. Excellent.